Have you ever wondered how interest rates shape your financial world? And are you missing out on opportunities because you don't understand it? Recently, you may have heard the news about Federal Reserve and the European Central Bank decide to maintain interest rates at the current level. What does it mean for you and your hard-earned money? In today's video, I will answer all these questions, and by the end of the video, you will gain a clear understanding of how interest rates work and their impact on you. If you're new to my channel, my name is Charlene. I'm a chartered financial analyst with 10 years experience in finance across Asia and Europe. I make videos on personal finance, money tips, financial market and investment, career and personal development. Subscribe to my channel now to get one step closer to your financial freedom. Okay, let's get started. What is interest rate and how does it work? You probably know in real life, an interest rate is basically like the fee you pay for borrowing money. When you borrow money from a bank or a lender, they don't just lend it to you for free. They charge you an extra amount of money called interest. But today we talk about central bank's interest rate. The central bank is like the boss of a country's money or a region's money. You may have heard Federal Reserve or Fed is the central bank, the money boss of the US. Also, you may have heard European Central Bank or ECB as the central bank or money boss for the European Union. They set something called an interest rate, which is a special rate that affects how much all the other banks in the country or region charge when they lend money to people and businesses. Here's how it works. Lowering interest rates. When the central bank lowers the interest rate, for example, from 5% to 4%, it's like giving a signal to all the other banks to make borrowing money cheaper. If you want to borrow money for a home or a car, the interest rate from your regular bank will be lower too. That's good news because it means you can borrow money more easily and at a lower cost. Central banks do this usually when they want to stimulate the economy to raising interest rates. On the flip side, if the central bank raises the interest rate, it's like telling the other banks to make borrowing money more expensive. So if you want to borrow, you will have to pay higher interest. This is to slow down the economy when it's growing too fast and to keep inflation in check. In a nutshell, interest rate is like a tool for central bank to use to control the country or region's economy, especially to control inflation. When they want people to spend more and invest, they lower the interest rates to make borrowing money attractive. When they want to cool things down to prevent too much inflation, they raise interest rates to discourage borrowing. Okay, here, if you don't know what is inflation, please check my previous video on all you need to know about inflation and deflation in 10 minutes. You get everything there. I put the video link here, also in the description area. In simple terms, inflation means prices are going up. Things are getting more expensive. Okay, before we answer the next question, if you so far found this video helpful, please don't forget to give a like and subscribe. Okay, let's continue. Why did interest rates get so high over the past few years and why are they pausing now? If we want to answer this question, we have to mention COVID-19. Interest rate cuts since COVID-19. Interest rates and inflation have been making headlines for the past few years. It began when COVID-19 started. Almost overnight, factories and business were closing, employment rates were rising, and economic growth was going down. Back then, I was a banking journalist in Hong Kong writing and covering all this stuff. Some of my colleagues were let go because of the slowdown in economy and business shutdown as well. Global stock market went down and people were panicked. People stopped buying things because you don't know if you still have a job tomorrow or not. You still like Chanel bag or you want to upgrade your car? Okay, let's wait for a bit. Against the backdrop, central banks, cut interest rates in order to make borrowing costs cheaper and encourage businesses and people to take loans and spend money. Their goal was to stimulate the economy. However, after a while, new problems came. What's the new problem? Inflation. As we mentioned before, inflation is price going up. Why inflation has been making a key headline since COVID is because of the imbalance of demand and supply in the market. On the demand side, we just mentioned during COVID, most central banks across the globe lower interest rates to stimulate the economy because they wanted to take some pressure off the economy. On the government side, most governments decided to focus on supporting citizens through spending programs. Back then, when I was in Hong Kong, I received a 10,000 Hong Kong dollar government voucher to spend. I was forced to spend money. Demand was pushed up, right, by government, by central banks. However, on the flip side, we continue to have supply issues. Remember, factories had to shut down because of COVID, and a lot of countries, especially in Asia in early 2022, most places still under lockdown. Supply cannot keep up. When supply is smaller than demand, price or inflation goes up. To make things worse, Russia's invasion of Ukraine disrupted energy supply, driving prices even higher. Global inflation was on the rise, prices kept going up, reaching levels that we haven't seen since the financial crisis in 2008. Just to mention a few data points, inflation in the US surged to over 8% in 2022. UK peaked above 11% that year. Turkey suffered the most, with prices rising 72%. I also need to point out that although this was a common trend across the globe, some countries, individual countries like China and Japan, face relatively slower inflation. In the near future, we'll look at what makes the economies unique. Subscribe to learn more. Okay, in front of high inflation, most central banks, led by Federal Reserves in the US, started to raise interest rate in early 2022 to curb inflation. The US Fed, European Central Bank, and Bank of England increased rates consistently over about a year and a half. Recently, in the last quarter of 2023, however, those central banks stopped raising interest rates. Why? Because they feel interest rates are high enough for now. They can't keep raising interest rates because they will damage economy eventually. Imagine if central banks keep raising interest rates and make it more hard and more expensive for people and business to borrow money. Higher interest rate can also make it harder for people to afford mortgages, right? People have less incentive to spend, which can lead to slowdown in the economy. According to comments made by various central bankers, we can expect those interest rates to be mostly maintained at the current level, but they will be high for some time before they begin making the way back down. I hope it hasn't been too overwhelming so far. Again, if you found this video helpful, please don't forget to give a like and subscribe. Now it's time to answer the million-dollar question. What does the pause in interest rate mean for you and your hard-earned money? Theoretically, imagine if you're a saver or a small investor who puts money in savings account, although I don't recommend. When interest rates go up, it means the reward or interest you earn on your savings also goes up. So that's generally good news for savers because you can earn more money on what you've saved. However, beyond that, when interest rate hikes stop, it means they're not going up anymore, but they're also not going down. This can have a few effects on small investors. One, stable earnings. As I mentioned, your savings will continue to earn the same higher interest rate that was set before the hike stopped. Two, potential for risk. If the central bank stopped raising interest rate because they're worried about the economy, it could mean there are economic challenges in the market ahead. They can make the stock market more uncertain. The value of your investment may not grow as fast as it was. Three, borrowing costs. If you're thinking about borrowing money, like getting a mortgage for a house or a loan for a business, stable interest rates mean you won't see a sudden increase in borrowing cost. It can be helpful if you're planning to borrow, but some people may want to wait until interest rate go down a bit because they want a cheaper loan if they want to fix the term. In simple terms, when interest rate hikes stop, it means you're not getting as much of a boost in your savings as when they were going up. But at the same time, it suggests the economy may not be doing so great, which could affect your investments in other ways. It's a bit of trade-off, and it's important to keep an eye on what is happening in the economy to make informed decisions about your money. Finally, because interest rates are closely tied to the topics of inflation and deflation, as I explained in the video, I highly recommend that you watch my video on all you need to know about inflation and deflation in 10 minutes. I will see you in that video.